Hello everyone and welcome to the International Business Law podcast series. I'm your professor Glenn Torres-Spelliscy. Thanks for joining me. This week, we continue our discussion of trade, but we move on to talk about trade protection. Now, there are two reasons why a government might want to protect its domestic market from international trade. The first is in response to unfair trade practices. When a country believes that its trading partner is violating international laws in the way that it conducts trade, the country is authorized to respond by imposing tariffs and controls in response. Second, there are some legitimate protections a country may place on domestic markets even in the absence of unfair trade practices. And these relate to things like national security. As a country seeks to liberalize trade markets through the application of the principles of non-discrimination, most favored nation status, and quota elimination, it must also establish ways to protect its market, should it become necessary. Indeed, international law has developed over time to try to limit the effects of certain practices that it has deemed unfair, and to grant countries certain limited rights to protect their markets in response to those practices. When producers in one country sell products in another at below market prices, they undercut the ability of domestic producers to compete, thereby driving them from the market. This is called dumping in international trade law and is considered a predatory, unfair practice. As a result, trade law provides a way to counteract such activity. Let's dig deeper with an example. Let's say that we have two factories, one in the United States and one in China. Both produce solar panels and both sell in the US market. If the Chinese competitor starts to sell its goods at 30% less than its production cost, it will drive US domestic producers out of business. So our domestic producer can go to his government and complain. In the United States, complaints are filed with the US International Trade Court and the Department of Commerce. If after an investigation the government concludes that dumping is occurring and that it is causing harm to the domestic industries, the government can take measures to protect its domestic industry. It does so by imposing a tax or duty at the time of importation. So if our Chinese competitor ships to the US, the solar panels will be stopped at the border, and a duty will be imposed to counteract the effects of the dumping and allow domestic producers a chance to compete. The duty must be designed to level the playing field and allow competition, not to tilt the playing field to the advantage of domestic producers. Another trade practice that is scrutinized as potentially unfair is the use of government subsidy. Now, this can be a controversial topic because many governments, including the largest economies such as the US, China, and the EU, spend billions of dollars each year subsidizing certain industries. And that isn't to say that all subsidies are unfair trade practices. Some types of subsidies are allowed under trade rules and others are prohibited. The law recognizes that sometimes government investment in an industry is valuable. What it is trying to regulate is when that investment creates unfair levels of competition. Subsidies that require recipients to meet certain export targets or to use domestic goods instead of imported goods are prohibited because they are specifically designed to distort international trade and are therefore likely to hurt other countries. For other subsidies, termed actionable subsidies, it matters what the effects are. Here, the complaining country has to show that the subsidy has an adverse effect on its interest. The agreement defines three types of damage they can show to demonstrate the injury. 1. Subsidies can hurt a domestic industry in an importing country. 2. They can hurt rival exporters from another country when the two compete in third market. And 3. They can hurt exporters trying to compete in the subsidizing country's domestic market. Thus, where trade materially injures a domestic market, the rules of GATT and the WTO allow countries to protect their markets through narrowly tailored safeguards, escape clauses, and anti-dumping duty. If there is no material injury, then the subsidy is permitted. Protections are enforced through the customs process. That's the process that goods must go through any time they cross international border. Typically, this involves 3 stages. First, identifying or classifying the good and the country of its origin. Second, valuing the goods. And third, imposing the tariff or tax at the appropriate level. Many aspects of this process are harmonized among WTO members through the use of the Customs Valuation Code or GATT Agreement on the implementation of Article 7. Let's use an example. Let's introduce our business person here, and they are wondering what to do. Then they have an idea. They're going to import certified organic coffee beans from Ethiopia, a country known for its flavorful Arabica beans. So our hero is feeling good about their idea. They locate a plantation, sign a contract, and arrange for shipment. But there's one more step. They need to determine the import duties that must be paid. This is a cost of doing business internationally, and our business person must plan for it. But how do they figure it out? Well, ultimately, the amount of duty that is charged is determined by the Customs and Border Patrol. But there are certain things that a business person can do to determine the cost. The most sure way to determine cost is to get a binding ruling from the agency, but that takes time. The second thing our business person could do is hire an outside classification firm to help. This is a good idea, and there are a number of different issues to consider in hiring an expert makes sense. Now, our business person could also do some research using free government resources to determine the general cost. We will do some of this general research ourselves in upcoming assignments. This might just be a first step to see if the transaction is even cost-effective or allowed under the rule. The classification involves both what the good is as it enters the country, this will be determined by reference to domestic codes, and from where the good originated. The country of origin, however, is distinct from the country in which the good most recently resided. Classification is done through the harmonized system put together by the WTO. In the US, the harmonized schedule is monitored by the US International Trade Committee. So let's go to the website. Here we enter in a search term. Let's enter coffee. On the left-hand side, you will see the classification number. That is the number that is referred to on the harmonized schedule and should be prominently displayed on your imported goods and documents. We have a number of different coffee types to choose from, so we identify certified organic Arabica beans, not roasted. Now we look over at the rates and we see 3 columns. The first column is divided into 2 parts. Section 1, labeled General, lists the tariff rates for all countries with whom the US has normalized trade relations, otherwise known as Most Favored Nation status. Now, as a member of the WTO, remember that all other members should be afforded this status, so most countries will be governed by this column. The second column lists other countries that the US may have free trade agreements with, which may further reduce rates. The last column, marked 2, refers to those countries that we don't have normalized trade relations with. Right now, only North Korea and Cuba. But given sanctions, it's not like a lot of business can be done with those countries anyway. So we can see here that our businessman can import the coffee without a duty. Now, if it wasn't coffee, but some other type of powder like dried or crushed paprika, for example, they may have to pay such a duty. Tariffs may be based on the value of the item, such as charging 10% of its value, or charged on a per piece, i.e. weight, basis. Value can be determined by a number of methods, but the most common method is to use the transaction value, the actual price paid for the good. Where this cannot be determined or cannot be fairly determined, such as in instances where the seller and buyer are related, there are a number of different calculation methods. First, customs may look to the transaction value of identical goods or the transaction value of similar goods. This will provide a good approximation of value. If that doesn't produce results, customs may look to the deductive value, which is determined by examining the price the goods are sold to an unrelated buyer in the greatest aggregate quantity in the country of importation. Customs could also use the computed value, but this is the most difficult and rarely used method. It determines the custom value on the basis of the cost of production of the goods being valued, plus an amount for profit and general expenses usually reflected in sales from the country of exportation to the country of importation of goods of the same class or kind. Finally, if all else fails, customs could use what's called derived value, which simply means using reasonable means to come up with the value. Once the classification, value, and country of origin are known, the tariff can be calculated. Just as countries control the import of goods, they also control the export of goods from their country. Whereas the former primarily focuses on the protection of a domestic industry and sometimes the health, safety, or morals of its citizens, the latter typically focuses on preventing certain technologies and items, such as weapons, from falling into foreign hands. There are national security issues involved in many such controls. Keeping a competitive edge in new technology, even if not typically usable by foreign militaries or anti-US terrorists, also constitutes a reason for imposing selective control. Sometimes a country can also seek just to protect scarce or important resources. Businesses must take care to be aware of export controls to make sure that they are not violating laws when exporting goods abroad. Well, that's it for this week's short podcast. Go on to read the lecture book and the chapters, and if you have any questions, you can find me on the discussion board.